Hello and welcome to this introduction to IFRS video series where we will be discussing about the various IFRS standards. Today we will be discussing about financial instruments and discuss how IFRS 9 and IAS 32 define the various financial instruments, their classification and initial and subsequent measurement. This is CA Ujjwal Khanal from Easy Books Consult. Easy Books Consult provides easy and convenient accounting and reporting services. But today, let us focus on the financial instruments. IFRS 9 has developed over a period of time. The older IAS standard 39 came into effect in 2005, but since financial instruments is a complicated area, IAS was eventually replaced by IFRS 9, which is effective from the period starting on 1st January 2018. The objective of this IFRS is to establish principles for the reporting of the financial assets and financial liabilities that will present relevant and useful information to the users of the financial instruments for their assessment of the amounts, timing, and uncertainty of an entity's future cash flows. This standard shall be applicable to all the entities to all types of the financial instruments except interest in subsidiaries, associates, and joint ventures, which are accounted for under the various other IFRSs. However, IFRS 9 applies in cases where, under those standards, such interests are to be accounted for under IFRS 9. IFRS 9 does not apply to the employer's rights and obligations under employee benefit plans, to which IAS 19 employee benefits applies. It also doesn't apply to forward contracts between an acquirer and shareholder to buy or sell an acquiree that will result in a business combination at a future acquisition date. It also does not apply to the rights and obligations under the insurance contracts and financial instruments that meet the definitions of own equity under IAS 32. Financial instruments, contracts, and obligations under the share-based payment transactions to which IFRS 2 applies do not attract IFRS 9. IFRS 9 is also not applicable to the rights to reimbursement payments to which IAS 37 applies. Now let us look at the definitions of the various terms that we will come across in this IFRS. Financial instruments. A financial instrument is any contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. Financial assets. A financial asset is any asset that is cash or an equity instrument of another entity, or a contractual right to receive cash or another financial asset from another entity, or a contractual right to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity. We can also define financial assets as a contract that will or may be settled in the entity's own equity instruments and is a non-derivative for which the entity is or may be obliged to receive a variable number of the entity's own equity instruments, or a derivative that will or may be settled other than by the exchange of a fixed amount of cash or another financial asset for a fixed number of the equity's own equity instruments. Now let us define financial liability. A financial liability is any liability that is a contractual obligation to deliver cash or another financial asset to another entity, or it is a contractual obligation to exchange financial assets or financial liabilities with another entity under the conditions that are potentially unfavorable to the entity. It can also be defined as a contract that will or may be settled in the entity's own equity instruments and is a non-derivative for which the entity is or may be obliged to deliver a variable number of the entity's own equity instruments, or a derivative that will or may be settled other than by the exchange of a fixed amount of cash or another financial asset for a fixed number of the entity's own equity instruments. So what are the equity instruments? Well, an equity instrument is any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. Further, financial instruments is an equity instrument only if both of the following criteria are met. Number one, there is no obligation to deliver cash or another financial assets or to exchange the financial assets or financial liability, and the issuer will exchange fixed amounts of cash or another financial assets for a fixed number of its own equity instruments. Examples of equity instruments are ordinary shares, share warrants, mandatory convertible preference shares, and non-derivative contract for which the entity may be obliged to deliver fixed number of the entity's own equity instrument. Now, we can also say that for any financial instrument, if any entity has an unavoidable contractual obligation, the instrument is a liability, otherwise, it is an equity instrument. We can also analyze the features of liability and equity, where the liabilities are an obligation to pay cash, mandatory redemption, which are settled in a variable number of the entity's own equity instrument, and it is only a contractual or a conditional right to avoid indirect obligation and contingent settlement provision. The features of equity are as follows: discretion over cash payments, fixed amounts of cash for a fixed amount of shares, that is the fixed for fixed criteria, and it is not dependent on the ability to make distributions, intention to make distributions, negative impact on ordinary shares, amount of issuers reserves, etc. So we can conclude that any derivative that will or may be settled by exchange of variable number of the entity's own equity instruments are financial assets or liabilities, but the derivative that is settled by the delivering fixed number of entity's own equity instruments are equity instruments. Now, let us discuss about the classification of financial assets. An entity shall classify financial assets based on their subsequent measurement at either amortized cost or fair value on the basis of two criteria, namely the entity's business model for managing the financial asset and the contractual cash flow characteristics of the financial asset. Entity's business model means the objective of holding the financial assets either held for trading or for collecting contractual cash flows. Entity's contractual cash flow characteristics of financial assets means whether contractual cash flows are solely payments of the principal and interest on the principal amount outstanding. A financial asset shall be measured at amortized cost if the two conditions are satisfied. The first, the asset is held within a business model whose objective is to hold the assets in order to collect contractual cash flows, and number two, the contractual terms of the financial assets give rise on specified dates to the cash flows that are solely payments of principal and interest on the principal amount outstanding. All other financial assets shall be measured at fair value unless it is measured at amortized cost. There is another classification called fair value through other comprehensive income, which is at the discretion of the entity and is applicable for equity instruments that are held for trading as well as debt instruments that do not meet both the conditions of classification at amortized cost. And also, an entity has the opinion to designate a financial asset at fair value through PL irrevocably if doing so eliminates or significantly reduces a measurement of recognition inconsistency that would otherwise arise from measuring assets or liabilities or recognizing the gains and loss on them on different bases. Now, for better understanding of the classification, let us look at the flowchart for debt securities. A debt instrument that is held within a business model whose objective is to hold financial assets to collect their contractual cash flows, and the contractual terms of the financial assets give rise on specified dates to the payments of principal and interest, must be measured at amortized cost unless the asset is designated at fair value through PL under the fair value option. A debt instrument that meets the cash flow characteristics test and is not designated as fair value through PL under the fair value option must be measured at fair value through other comprehensive income if it is held within a business model whose objective is to hold the financial assets in order to collect contractual cash flows and sell the financial assets. All other debt instruments are measured at fair value through profit and loss. IFRS 9 contains an option to designate at initial recognition a financial asset as measured as fair value through PL if doing so eliminates or significantly reduces any accounting mismatch. Now, for a better understanding of the classification, let us look at the flowchart for equity instruments. All equity instruments in scope of IFRS 9 are measured at fair value in the statement of financial position, except for those equity instruments which are not held for trading, for which the entity has elected to present value changes in other comprehensive income. The option to designate an equity instrument which is not held for trading at fair value through OCI is available at initial recognition and is irrevocable. This designation results in all gains and losses being presented in the other comprehensive income except dividend income, which is recognized in profit and loss. Now, let us talk about the classification of financial liabilities. IFRS 9 classifies financial liabilities into two categories. The first one is financial liabilities at fair value through profit or loss, and here the liabilities that are held for trading and liabilities that are designated at fair value through PL are classified. So, like in the case of financial assets, there is this irrevocable choice to classify the asset at fair value through profit and loss. The second category of financial liabilities is financial liabilities at amortized cost, and all the other financial liabilities fall under these categories. Besides these two basic categories, IFRS 9 talks about three other categories of financial liabilities. More specifically, it talks about the liabilities that are related to the failed derecognition of assets and the accounting for these assets to the extent of continuing involvements. Then, about the financial guarantee contracts that you issue to someone else, and lastly, about some loan commitments to provide loan at below market rate. So, we have now covered the classification of financial assets and liabilities in short. Now we should talk about the measurement of the financial assets and liabilities. As we are now clear that the measurement of the financial assets and liabilities depend on the classification of the assets and liabilities. At initial recognition, an entity shall measure a financial asset or liability at its fair value plus or minus the transaction costs that are directly attributable to the acquisition or issue of the financial asset or liability, and in the case of a financial assets or financial liability, not at fair value through profit and loss. In case of financial instrument through profit and loss, the instruments are measured at fair value. Transaction costs are very important. Now let us look at the treatment of transaction costs by IFRS 9. Transaction costs in case of measurement at fair value are immediately recognized in profit or loss on initial recognition, whereas in case of instrument measured at other than the fair value through PL, the transaction costs are added to the fair value in case of financial assets and deducted from the fair value in case of financial liabilities. Now let us talk about the subsequent measurement. As discussed in initial measurement, the subsequent measurement also depends upon the classification of the instruments. So all the financial instruments measured at fair value shall subsequently be measured at fair value at the date of remeasurement, and all the other financial assets and liabilities shall be subsequently measured at amortized cost using the effective interest method. So how do we recognize or account for the changes arising from the subsequent measurement? It depends upon the class of the financial instrument and the type of the change. As we learned earlier, the financial instruments at fair value can be split into two subcategories. The number one, the fair value through profit and loss, and the fair value through other comprehensive income. All changes in the fair value related to the instrument at fair value through profit and loss shall be recognized in the PL, except for gain or loss on non-derivative financial liabilities that is attributable to the change in credit risks. Such changes are recognized in the other comprehensive income. The second category, fair value through OCI has two subcategories. The first subcategory is equity instrument at fair value through OCI. Only dividends are recognized in profit and loss, with all the other gains and losses, including foreign exchange gains or losses, are recognized in other comprehensive income. Upon derecognition of the amounts in other comprehensive income, the amounts are not reclassified to profit. The second subcategory of the financial instruments at fair value through OCI is the debt instruments that meet the contractual cash flow characteristics but are not for hold till maturity. The changes in the fair value of the instruments are recognized in other comprehensive income, and all other changes like interest impairment and foreign exchange gains or losses recognized in the profit or loss. Upon derecognition, amounts in the other comprehensive income are reclassified to profit and loss. The third category of the measurement is financial instruments measured at amortized cost. Here, the changes in fair value are not applicable. These instruments are measured at amortized cost, and foreign exchange differences and impairment related to the financial assets are recognized in profit and loss, and any interest income or expenses are recognized in profit and loss too. The effective interest rate method has to be used in these cases. Well, that is all about the classification and initial and subsequent measurement of financial instruments. We will be discussing the impairment of the financial assets, derecognition of the financial instruments, embedded derivatives, and hedge accounting in the next video of our financial instruments. And if you wish to learn more about this topic along with examples and practical implications of the same, please feel free to contact us at easybooksconsult@gmail.com. Please feel free to subscribe to this channel and hit the notification bell so that you do not miss any new videos related to IFRS or any other financial matter.